For this edition of the Business of Marketing, we're going to talk a little bit about the mortgage crisis and the mortgage settlement deal, which supposedly solves once and for all the robo-signing thing, except that it really won't solve that much. The I have argued, and I've done this for several years. I was on the radio show Business Matters about a year when this thing kind of broke, when the robo signing thing kind of broke, and I warned about the dangers of not doing something about this, or not trying to find some way to settle the issue quickly, because it has really aggravated the housing crisis. And I don't think one of the things that you didn't see, and you've probably seen or read something if you're into business news or a person that works in business, you probably read or heard people talking about the mortgage settlement, and it's really not clear what's going on. The number that's on there is $25 billion, but it's not really clear until you read into the fine details of the situation, exactly how the money is being distributed. Let's go back and talk a little bit about the housing crisis and what happened. There was a huge run-up in some areas of the country, a monster run-up in housing prices in the period from 2000 to 2006, or from some 98 to 2006, depending on how what type of where you were and what type of market there is in the area where you live. A big run-up in prices. And I'm from Florida, and most of my family still live there. And there's a huge run-up, and we were looking to buy some property to eventually build a retirement house on, or a second house on in Florida. So we were actively looking for property in Florida at that time, when at the top of the market. And it was fairly clear it was such a huge markup. And I had people in my family telling me, you got to get something now. It's going to go up even farther. And when bubbles happen, that's what happens. The psychology of things going up and up and up and up and up becomes, it kind of makes people forget. And I was fortunate enough to have lived through the 74-75 recession, and the drop in the housing market that kind of preceded that, or is a precursor to that. The price of oil went way up. A lot of the things that are made from oil went way up, and there had been a big run-up in prices, and there was a huge bubble. And in particular, Florida seems to get hit by these the worst. And we had a very, very similar situation where you had all these foreclosures going on. The home next to us was half built. They had a business called Commonwealth that was one of the biggest REITs, and was headquartered in my hometown. And they went belly up. And then when the bankruptcy examiner came in here, and he said, well, they've been belly up for a while. And what they were doing was, if somebody couldn't pay them, they would just lend them more money. So that especially there was a group of what they called friendly builders in our area, and if somebody was, many of them were in our area, and if one of them couldn't pay, then couldn't make an interest payment, well, then Commonwealth would just lend them more money, and then they would make the payment, and then they would look current, and made the books look good, and so they were a house of cards for quite a while before they actually fell. Before the house of cards actually fell. And in the situation where we had the crisis, and it is probably the worst crisis of our lifetime, and since the Great Depression, the worst financial crisis we've ever had, which kind of all came to a head in 2008. But we had a situation where people were borrowing money, and they were paying 3% down. In some cases, they were paying almost nothing down. They could, and if they did have to pay 3% down, they could. Most people have access to a credit card, and so they were using the credit card to come up with their 3% down. And then there were also situations where they were getting a credit from the builder to make the down payment. In other words, whoever built or whoever owned the home would give them a credit in order to make a down payment, and then they would borrow money. And in the book, The Big Short, there's the famous story, the one that's repeated over and over again, is about a illegal immigrant fruit picker strawberry picker that made $18,000 a year, that bought a $700,000 house. And at that time, the secondary market would take anything. And they had what they were called ninja loans. No income, no assets, no ability to pay back the loan. And I don't know where you get the ninja from that, but that's what they came to be called, these liar loans, where people could put anything down that they wanted for their income, and they would get the loan because nobody verified anything, because that wasn't one of the requirements of the secondary market. Now, we've had real estate booms and busts before. And the study of the history of Florida, which of course everybody in Florida studies in the fourth grade, but I also studied again as a PhD student, because I was a PhD student at Florida State, and this is one of the things that we studied. I had a really good professor that made us read these historical things, and I've always emphasized to the finance professors here how important it is to understand the history. I mean, if you really want to be prepared and you understand that there are panics, there are times when everything goes up, and there are times everything goes down. And I remember my dad. They made a couple good real estate deals during the run up before the big drop off in 73, 74. There was also a big run up in farm prices in the I believe it happened in the the late 70s, and then the bust came in the early 80s. If I remember during the 70s, it was a big run up, and everybody was worried about the Arabs buying our farmland, because they were coming over here and using their oil money to buy farmland at exorbitant prices. And of course, what we did was we basically snookered the Arabs out of a lot of the oil money that they snookered us out of in the first place. Snooker is probably not the right word for that, but it's the best I could come up with. That big run up in farm prices, and then there was a long period in which the farm prices fell, and every day I can remember talking to a farmer said, yeah, every day it's going lower. And I want to say this is in the early 80s. So the history of business, you have these run-ups in real estate prices. And one of the reasons is that the crisis is fueled by, and like all booms, is fueled by psychology. I mean, at one point in the year 2000, the NASDAQ index, which is a tech, filled full of new tech companies. There's a few old companies in there, but many of the companies were, tech companies, and you had a company like Priceline that went from $100 to $1. A company like Yahoo, and I'm giving the split adjusted numbers here, I think it went from 100 to 4.5. Other companies that went, completely belly up. A lot of the new startups, the people who were trying to sell furniture online, and the grocery stores, Webvan and Streamline, and many of those dropped out. I think Peapod is still around in the web grocery business, but you had this huge run up, and when they called the people in, the analysts for Merrill Lynch and some of these other companies said, how could you tell people to buy these stocks? Well, one of the things is that the experts are just guessing too, really, in a way. Unless they have inside information, if they've got the same information everybody else has got, and they do get inside information, because every time you listen to an analyst briefing, and you can listen to these things on the web, and if you have an interest in this, I highly recommend that you listen. And if you can skip a lot of the stuff and just go to the questions at most analyst briefings, even for stocks you own, I would just not even listen to the other stuff, the first 45 minutes, and when the analysts ask questions, they're always saying, well, I'll talk to you later about this, or I'll talk to you later about that. And if there's a FD, how come the analysts are allowed to talk to the CEO privately? I mean, that shouldn't be allowed. If you have full disclosure, that's why you do those things on the web. But so they do get some inside information. They may not trade on it, but they do get some inside information sometimes to make recommendations, despite what everybody says. I mean, as much as they try to keep the game clean, people know more than you know that are invested in the stock market. But the analyst that that were asked, hauled into Congress, and of course the congressmen are some of these same congressmen were buying stocks at buying tech stocks and NASDAQ stocks as the market went up into the 5,000. So they weren't any smarter than the analysts. So how could you keep recommending these stocks? How could you recommend this stock, when the market was 4,500? And how could you recommend it? And they said, well, one of the analysts just said honestly, one of the female analysts that they that they hauled in there said, when the stocks are going up and up and up and up, it's hard not to say buy. I mean, if you stop and say don't buy, and it's going up and up and up and up and up, and for me, I remember one stock that I owned and actually bought again towards the bottom of the market, but I thought it was overvalued when the market was 2,600, and the stock, the market went up into 5,000 as a stock, and I sold. I thought it was way overvalued. It wasn't worth that much. Well, then it goes up to 5,000, and the stock basically doubled that I own, did about the same as the market. Well, who's smart and who's dumb? Now, it turns out that stock went down. When the market went down to 1,200, the stock ended up at less than half of what I had sold it for. So was I smart or was I dumb? Well, I was smart in recognizing that it was overvalued. That particular stock was overvalued, way overvalued. It ended up when the market cleared out, it ended up being worth much, much less than that, and still today is not worth what I sold it for. It's not worth what I sold it for right now. So that stock, was I smart when I said it's overvalued? Because then it went and doubled right after that. Or were some of these analysts that said buy, 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 were they smart? And the old rules don't matter. It doesn't matter if something has a 1,000-to-1 PE ratio. Who was smart? Well, in this real estate crisis, as things went up and up and up and up, some people made a lot of money. They bought near the top of the market, and then they turned around and sold at the top of the market. Now, of course, many times they went and put whatever profit they made into something else at the tip top of the market, and eventually they got caught. But the psychology was that, it's going to keep going up. And people in my family tell me, but I remember these other things, and I had to study Florida history and the big real estate booms and busts that have been, regularly occurring themes in Florida. And I remember the farmland boom and bust that came after that, after the 73, 74 recession. This was something that happened after that, the farmland boom and bust. So I remember that, and I remember saying, no, that's not true. When things get too high, and there's a cushion, there's something happens, and I think some of the smart people, Rubini and Nouriel Rubini and some of the others, were looking and saying that one of the things that fueled this crisis was too much money, too much secondary market money. And the reason for that is that there were people, they come up with new ways to hedge these different things. And what they did was they cut, when you got a mortgage or somebody else got a mortgage, they would take a bunch of these and we would put them in a package. And then they created, out of that package, they created these different tranches, a kind of floor level that was very risky, and the bottom tranche, it would only get paid if the top tranches, and then there would a mezzanine level tranche, and then a tranche that got paid first. And I don't think anybody really recognized at one time that things are correlated. And I think this is a big point that in the book, The Big Short, was that a lot of these things that everybody thought, well, okay, I've got 1,000 mortgages. And out of 1,000 mortgage, we know that some of these are going to go into foreclosure. Some of these people are not going to pay off, but that it's kind of random. In other words, we're by having 1,000 mortgage in a package instead of 10, we're spreading our risk out, and the probability of having a large number collapse was much less. But people forgot that when the economy goes down, home prices go down, that these things happen together. That there's external causes that cause the mortgages to fail. So what we had essentially was a situation where the only way that many people could pay a lot of these things off was if the market kept going up, because they were getting 97% loan to values. They were 30-year mortgages where you pay almost the first few years you pay only principal. In some cases, some of the loans that were made were really exotic. Some of the ARMs, you only paid interest for like 2 years, and you got a real low teaser rate. A lot of the adjustable rate mortgages had very low teaser rates for 2 years. And that was how they calculated whether you could qualify for the house, was whether you could afford, you had enough money to make the payments for the first 2 years. And of course, if nobody was verifying anybody's income or ability to pay or credit history or anything, well, it didn't matter anyway whether people were really qualified or they weren't qualified for the loans. So in a way, a lot of people blame the mortgage brokerage companies. And it's interesting to read both sides of the argument. The truth is, nobody likes this new mortgage settlement deal. The conservatives, Dick Bove, calls it a deal made in hell. If you read the blogs on Huffington Post and Talking Points Memo and places like that, they hate the deal because it doesn't do enough for homeowners. The amount of money, the amount of total dollar amount of mortgage, for example, that are underwater is, close $780, $800 billion, and there's $25 million in this deal. Only a piece of that goes for only a piece of that goes for helping people whose loans are underwater. And so everybody, people on this side don't like it, the people on that side don't like it. And a lot of the political arguments related to this sound really silly to business people. For one thing, the whole robo-signing thing occurred because the big banks and mortgage operations, they would sell these mortgages, and then they would be packaged together, and then somebody else would buy an interest in them, and they would create credit default swaps, CDOs, and then they would sell credit default swaps out of those, and they're transferred and assigned a number of times. I think when you look at some of the foreclosure documents and some of the trail, these things, the mortgages might be sold 5 or 6 times, transferred 5 or 6 times, and then they didn't want to pay a mortgage transfer fee. Most county clerks or the whatever official government entity, it's the clerk of the county court or clerk of the court in Florida, and in Tennessee, it's I forget what it's called here in Tennessee, the office, but there's a fee whenever you change like a doc stamps fee or some sort of fee, like $40, is kind of seems to be the standard where if you transfer the documentation, like one person owns the mortgage and they sell it to somebody else, they're supposed to pay a $40 fee to re-register that. Well, they didn't want to pay these fees, so what they did was they set up this MERS system, this electronic holding company that was supposed to keep all the data and have all of the stuff, and then they would keep track of it. It would transfer from, this group owned the mortgage, and they would transfer that right to this group, and then they would transfer the right to this group, and they would transfer that right to this group, and the MERS system kept track of all that. But they did ever pay their $40 fee for transferring it to the state. That was the whole idea behind the MERS. They wanted to get around paying those clerk of the court fees at the county courthouse all over the country every time they engaged in some transaction with that mortgage. So they wanted to get above the state level, and that was part of the start of the situation. And then in many states, and this is something that's set up by lawyers, they have a judicial foreclosure process where lawyers are involved, and there's a lot of expense for that judicial foreclosure process. I know the traditional figure in Florida is around $10,000, and what they did was they needed companies to go in and do that for them. They wanted to create a system where they could do that much cheaper, and then this guy Daniel Stern comes in. And he was a lawyer in Florida, and he set up like a factory operation where everything was done the same way you would have an assembly line in a car. He was assembly line in the process of doing these foreclosures, and they were able to do them for around $1,200-$1,400. Whereas banks would, in the old days, they go and they have to find a lawyer and they have to contract with him. And you can imagine, if you hold thousands of these things, what a hassle it would be to do that for every single mortgage, to get a lawyer, and you end up paying $10,000 in fees. Plus, you have a lot of interest and everything that people aren't paying. And so this Stern guy in Stern's office, and then it turns out there's some other companies that had been involved in this, DocX, a company out of Atlanta, that were also, after the Stern and his firm went under, they were also helping the banks with these large-scale, kind of a factory type of a foreclosure process. And naturally, they were found not to be scrutinizing all the documents. They didn't scrutinize the documents. They didn't. People would sign something without, and even notarize it without being sure that the facts were right. And of course, if you listen to NPR, they had a guy on there in NPR and says, "What about the thousands of people who were fraudulently foreclosed on?" And the fact that the banks and these servicers, the deal was actually not with the people who own the loans in many cases, but with the servicers. And of course, the servicers own many loans or have many loans in their portfolio themselves. They were kind of the five biggest banks. Bank of America being far and away the leader. I think Wells Fargo, J.P. Morgan, Ally was the smallest of the five. But these five banks that were the biggest servicers in the country. Now the deal may extend to another 9 smaller servicers, in which case I think the deal would be upwards of above $30 billion if they get the other servicers to sign on to the deal. So what happened was that they would go to the MERS system, and they would realize, in some states they have that don't use a judicial foreclosure process, like Tennessee. It's a fairly clean process. Somebody doesn't make their payment. You have evidence that they don't make their payment. Then you go and you foreclose. The process can take as little as 3 months in some of these judicial states, non-judicial states as much as 6 months. Somebody stops paying their mortgage. You get them out of the house in 6 months. You rent it or you sell it. And the truth is that the states that have non-judicial foreclosure have recovered from the housing crisis much faster. Housing is a very localized thing, a very local market to market. Our market is pretty much recovered here. We didn't have a huge runoff in the area that I live in here in Tennessee, run up in the area that I live here in Tennessee, and so we didn't have a big fall. But the housing crisis in areas where you had the judicial foreclosure, it started taking longer and longer and longer to be able to foreclose. And you had to actually produce the documents. In other words, as part of the process, just like in a court where, the plaintiff has to prove certain things first. Before you can even get started, they've got to come up with evidence. And the defense, the attorneys for the people who were being foreclosed would say, okay, produce this document, produce this document. Now the guy, and what happened was that one very sharp defense attorney noticed that some of the things had been some documents that had notarized signatures, and they had other signatures that couldn't have happened. In other words, the notary would be on something and the notary would say that it happened in 2008 or 2007, when actually the document was produced in 2008, and they had copies of stuff that were clearly wrong, or that the one thing that they caught really quickly was that they had documents that were notarized, and they were backdated and to like 2007 when the event occurred. And there'd be this notarized signature, and then the attorney checked the notary's, checked in and found out that the notary wasn't even a notary in 2007. The notary didn't become authorized to become a notary until sometime in 2008, but they've got all these documents that are signed and dated in 2007. and I probably have the years wrong, but the one really smart defense attorney, and several of the foreclosures were dismissed with prejudice because of the obviously fraudulent behavior of the of the banks that were doing the foreclosure, the servicers that were doing the foreclosure process. Of course, if you're the investor that holds the mortgage, and one of the arrangements is that the bank will maintain all the documentation, the servicer will maintain all the documentation, and they don't do it correctly. In other words, they lose the documentation, or they get caught doing something wrong. Well, they have that negligence is suable. I mean, you can sue to force them to buy back the mortgage, or to pay it off, or to pay you off as the investor. So what happened when this came out was that a lot of the investors that had bought these mortgages that had dropped off the cliff because nobody was paying them, this was their way to get paid off. In other words, they could sue the bank in order to get the bank to pay them off because they had breached the contract by not servicing it properly and not keeping all the documentation. Then on the other side, you have a lot of people that think, well, I'm going to get a free home. And there was this cottage industry of training attorneys to defend foreclosures, to vigorously defend the foreclosure process, and to demand, part of that process, demand this document, double check all the signatures, subpoena the people that signed them and saying, did you verify this information before you signed it? And then it starts coming out that there's been all this robo-signing. And the robo-signing now, of course, the Wall Street Journal is the only one that I saw that really pointed this out. If your neighbor next to you, they know the house is worth $100,000, $200,000 less than what they paid for it, and in Florida, for things to go down to half price or less is even if they're in good shape, the value in many areas has been cut in half. And so somebody owes $200,000 more on the property that they own than it's worth. It's worth $200,000. They paid $400,000 for it. Honestly, they'd be crazy to pay that off. I mean, I know people want to stay in their homes, but they'd be crazy to pay that off. So what they have the option, they can stay there for several years because it takes an average of 1,000. That's incredible. I mean, I just find that hard to believe. 1,000 days. I know we have an officer, Edward Crone, that came to he's one of the senior executives of Wells Fargo, and he came to my class and said it takes 2.5 years in Florida, and that's incredible. So they can stay in that house for 2.5 years, and then all of a sudden it turns out that one of the documents that is in the foreclosure process was robo-signed. It's not wrong, just robo-signed. Now, if you listen to the left-wing kind of NPR, Huffington Post take on this, well, that poor family was fraudulently foreclosed on. And what are we going to do to help them who were fraudulently foreclosed? Now, they just stopped paying on the mortgage. They lived there for several years without making any payments. And then, because somebody robo-signed something, now they didn't pay. They robo-signed something. Are we going to give them the home for free? I mean, how fair is that? I mean, how fair is that to the people next door that did pay? And in the meantime, of course, they're not paying their taxes. They let the taxes go because they're going to lose the house anyway. They're not spending any money keeping it up. If it gets a leak, they just put a bucket under it probably. There's no incentive to keep it up, to fix it, to do routine maintenance, to make sure that there's not any problem. If a window cracks or breaks, and put plastic up. So pretty soon they're not going to do yard work, or they're not going to pay landscapers to come in and keep the yard work up. So pretty soon you have this, after 2 years, you have this blighted piece of property. It's had a for sale sign on it for 2 years, talking about short sales and stuff like that. Short sales might work when, you can sell something that the bank has, say, if the bank has $400,000, lends you 20%, 80% of $400,000, and they, then the interest and fees and everything, it's 350,000, and you owe, 350,000. They might sell it for 310, or maybe 299, and that even that would they wouldn't want to do, but they're not going to sell it for 200,000, and that's what it's worth on the market. Nobody would pay $350,000 for a $200,000 house. It wouldn't even appraise if they did find a buyer. So they might have had to sign up, and all the other properties in the neighborhood the values are damaged by having this junky looking thing sitting there. In some big cities, you have drug dealers and kind of homeless people that'll I hate to pick on homeless people because I'd rather pick on like drug users and drug dealers. No, let's not pick on drug users. Pick on drug dealers. You have these bad people moving into these houses and using them for nefarious purposes, and in the meanwhile, it damages all the values of all the other homes in the neighborhood, and it takes so long because the judicial process is so convoluted. It takes so long to foreclose, and then in many cases, the banks have kind of been waiting because they're worried that they may have robo-signed something. They know that this was going on, and they're waiting for this settlement. In many cases, the banks were kind of waiting for this settlement before they moved on with some of these foreclosures. And if you have to wait, so the people stay there for 2.5 years, and now those are the people that are going to get money. Those people are going to get $1,800 on average. I think $1,800, $2,000. Small, and of course that was a small piece. I think $1.66 billion is going to be split up kind of nationwide among people who were foreclosed or who did lose their home, and they're going to get like $1,800. Well, to me, if somebody bought that place, they didn't only put up, especially if they only put up like 3%, got one of those, 97% specials. They only put up 3%, which even that they may have gotten like a builder's credit or some kind of phony. Even that may have been phony. So they have very little money in the thing. Then they got to stay there for nothing for 2 years plus, 1,000 days or, several years. And so I don't really feel sorry for those people. The people that were foreclosed on, because I don't really feel bad for them because maybe somebody signed a document that they didn't really verify. They didn't, and so most of the 750,000 people who lost their home lost it because they didn't pay them. They didn't pay. I don't think there's very many people that were keeping current and making the payments that were foreclosed on. Now, there may have been some rare cases where, documents are lost or people made payments. I have an issue with somebody here. I made a payment, $40. Then I got back from vacation, and I've been paying 18 years. I've been going to this, and it's here at the university. It's like university physicians, and I'm a university professor. And I paid $40 for a copay, paid the bill, and I got back from vacation, and they sent it off to a delinquent accounts collection agency. For $40 after, I've had open heart surgery, and I've had all kinds of things done, paid them hundreds of thousands of dollars, my end of stuff over the years. Have never had a problem. And it turns out I paid the $40 into my wife's account instead of my account. Even though to us it's together, to them they're separate. And I paid the $40 into the wrong account, and I go on vacation and come back with collection agency notice, which probably is a negative effect on my credit. There are situations where people may have made payments, and there definitely was an issue that I'm going to talk about in a few minutes with the problem with not knowing who owns a mortgage, and the reason why if they want to hedge, they want to create credit default swaps that are that they can insure against not being paid. And I understand the concept of hedging and cross-hedging and recross-hedging and all of that. I understand some of the basics of that, and I'm not necessarily against financial instruments that allow people to hedge because it improves liquidity and improves the working of the market. But at the same time, if you don't know who owns the mortgage, and that was the big problem, that when you take a mortgage and it's split, and if you know the first bit of money goes into this group, the next bit goes into this group, and the next bit goes into this group, and it's not clear who owns the mortgage, it makes it very hard to negotiate. It makes it very hard to negotiate. But now to get back to the crisis, so you have those people are going to get money. The states are going to get money. They're going to get about $2.66 billion. And that's going to be split up among the states. Several of the states have already said that they're going to, and supposedly it's supposed to do things to help blighted neighborhoods and to help, you know, the people who were hurt by the crisis, which to me, the people who have most been hurt by the housing crisis are the people who are in their homes, working hard, making a payment on a house that's worth less than what they pay, that's worth less than what they owe on it, or you know, much less than what they paid on it, and even less than what they owe on it. Those are the people who've really been damaged. The people who own the homes and are making the payments, and then watching their property value go down because this crisis has been aggravated by a lot of silly rules and a lot of misbehavior, have been aggravated by a lot of misbehavior. And then also I think our response, the government response has been really, really poor to the whole crisis. Now the settlement still allows the state attorney generals to sue these people or to pursue criminal charges against somebody who robo-signed. That's usually some very low-level functionary. The people doing the robo-signing were doing it because they had 1,000 of these things a week to do. And if they checked each one, they couldn't do it. And so they were put in a situation where, you know, it's not to absolve them of criminal negligence or guilt, but they were put in a situation where it was their job to sign off on things without being given the information to verify it. And so they can still be sued. The investors, the people who invested or held the mortgage, can still sue. The people who can't sue are people like you and me. The people who would sue because their mortgage was improperly processed or anything like that. So the banks got some release, and it's always put, and I read at least 10 different things about this, trying to find the details and watch these interviews of different attorney generals and stuff like that, including one really good one on Bloomberg, where the guy asked detailed questions about what's going to happen with that money. It was with the Attorney General of Connecticut. And he very clearly said, we're going to get like around $200 million, and it's up to the legislature what to do with that. I hope that we would use it for the right thing, but we may not. And many of the states have already said they're going to use it to cover budget deficits, much like they did with the tobacco settlement. But so the housing crisis and the robo-signing have really exacerbated each other. And so the banks have been unwilling to foreclose. And honestly, I think if what we had done early on was encourage people who didn't want their house to leave it quickly, that would have been probably the best solution. You go back and say, okay, what should we have done? Well, we probably should have allowed people, instead of focusing all our energy on keeping people in the home, if somebody has a home that they owe $400,000 on, it's only worth $200,000. Are we really doing them a favor to keep them in that house? Wouldn't they be better off leaving and renting somewhere? If they're able to make the payment, then they're able to make the rent. Are we really doing them a favor by that? No, we're not doing them a favor. The people, if we do that, by doing that, by doing everything we can to convince the people to keep paying that $400,000 mortgage on their $200,000 house, we're doing a favor to the banks. And I don't think that's one thing that the administration, right away, early on, the total focus was on keeping people in their homes. I think we've been better off if we let people that wanted to leave their homes and encouraged quick, fast, painless strategic defaults. One of the things they're doing is encouraging short sales. And short sales are a good thing. But the banks were so slow to recognize short sales. And banks are not very intelligent entities. Of the businesses that are out there, the honest truth is that the heroes of the financial crisis. And if we're now coming out of the recession that was caused by the financial crisis, the hero of that had been your Main Street business owner and manager. Many of the Main Street businesses operated very, very, very responsibly during this economic downturn. Many the corporate profits have been have been up. The corporations, very few corporations have gone under during this crisis, despite how severe it was. And the ones that did go under, there was probably not much that could be done to save them. Many of the Main Street businesses, they did the things that they needed to do. They cut back on discretionary expenses, hiring contractors, and cutting the cost side of the equation so that they could be lean and mean. And then they have come back and been very efficient about the way they operated, and corporate profits have actually surprised. And that's the reason that the stock market really is almost at the level it was before the crisis already. And that's the stock market is usually 6 months to a year forecaster of events to come. So that's probably a sign that things are going to get better. And if anything, the heroes of that. Now, the banks have definitely not been the heroes at any step of this process. And the biggest area that's still hurting is housing. And in a state like Florida, where you don't have a lot of factories, you don't have a lot of, because of the environmental rules, and they just don't want, they're not going to allow you to use a lot of water. You can't run your waste into the river the way they do here in Tennessee and stuff like that. So you're not allowed to use rivers for industrial dumps and things like that. So there's not a lot of factories in Florida, and so the construction industry is where a lot of your blue collar jobs are. Your ordinary kind of working class, work with your hands type of person that honestly is a person that made us great, and the person that Rosie the Riveter that got us through and defeated the Germans and Japanese in World War II and the Kaiser in World War I. Those type of people work by and large in construction, and when the construction industry is down, it really the economy is never going to recover. So the guilt lies more than anything else in having the judicial foreclosure process to start with. I mean, why is it necessary in the modern era to have judicial foreclosure? Why not have a streamlined foreclosure process? When you allow somebody to stay in their home for 2.5 years without paying the mortgage, that money's got to come from somewhere. I mean, the banks have got to make that money back somewhere else. They've got to have extra fees, or the investors that buy the mortgages, because of the extra risk, they've got to charge more interest. So that money's got to come from somewhere. And all of the attorney's fees and other costs that are involved in a 2.5 year foreclosure process, all of those things add cost. They're transactions cost to the process. Now, one of the reasons that the thing is so complicated is that and this is where the government needs to focus on the future to prevent this crisis from happening in the future. We need to have a situation where it's very clear who owns a mortgage. In other words, there has to be some sort of judicial, quasi-judicial documentation saying whoever this is makes decisions for all the other tranches, all the other investors, anybody that holds a CDO, anybody that's on the other side of a credit default swap, anybody that's on either side of that when it comes to servicing it, when it comes to, like, say, making a deal to write it down, or making a deal to for what I call a quick foreclosure, one without a deficiency judgment-free foreclosure. When it comes to that, there's somebody that can make that decision. So that when the servicer gets the documents, one of the things that happened was that even the servicers doesn't know who really owns that mortgage and who is going to make a decision. So when they go, okay, we need to get somebody on the other side to sign off on a short sale, or we need to give somebody on the other side, look, this house is not worth $400,000. These people are going to leave the home. They're going to turn it back into the bank. But if we forgive some of the principal, then maybe they'll stay in the home. Maybe if we knock down the principal to $320,000, they might stay in the home. And I definitely don't like the idea of the government getting involved in forcing the rewriting of private contracts. It just doesn't make sense to me. You have a contract, but now if two entities that are in a private contract want to get together themselves and rewrite the contract, they should be able to do that. And the best way to do that is to make sure that there is an entity somewhere that is on the hook for most of the money, that is able to make a decision and say, okay, we want to work with these people to keep them in the home. We'll either restructure the loan so that they have some forgiveness, or maybe there's a situation where somebody's laid off, and we'll charge them interest only, or we'll add the interest back to the principal, but we'll leave them in the home. They paid for 4 or 5 years. They've got a good credit history until they had a sickness in the family, an injury, a layoff, or whatever it was. Because we'll be better off if we restructure the loan than we will if we foreclose. Takes a long time to foreclose. Go through this whole foreclosure process, and then we can only sell the house for half of what we have in it. That's the way the bank would be looking at it. We can only sell the house for half of what we have in it. So they would negotiate themselves. They would be in their best interest. There are situations where it would be in the best interest of the investor who holds the mortgage. But when the mortgage is held by so many different investors and each one has these little pieces, and the servicer doesn't even really know who to talk to, and so they're trying to work with, and they get these fees and different things for doing these different things with the sending out notices and all foreclosure notices. So in many situations, there were people who were trying to work with the servicer to avoid foreclosure, and as part of that process, they were paying. They were making a different type of payments, or they were trying to keep up with the payments, even though they may have missed 6 payments earlier. At least they were keeping current with these payments in hope that the payments they missed might be restructured into a new deal, and then they could keep making payments and stay in their house. So if they could work with, if you don't know who the main investor is or who really owns that mortgage, you can't really make a deal. And then the servicers in many cases, and Wells Fargo in particular, and I'm not picking on Wells Fargo, but Wells Fargo in particular, they have home equity line of credit, and what's essentially a second mortgage. Because you get a tax benefit for borrowing money from a mortgage, many people went out and they took the equity in their home, and they went out and bought cars, boats, refrigerators. They used it like an ATM machine. Now, there's really not anything wrong with that. Really, not anything wrong with that from an individual personal finance perspective, because you get a tax break on that. If you're itemizing your taxes and you go out and you borrow money from a credit union, you go out and buy a car and buy a $30,000 vehicle, and you borrow the money from the credit union, that's not tax deductible. Whereas if you have a second mortgage line of credit, then you borrow from them. Well, that whatever interest you pay on that's tax deductible. And so many people, so many of the servicers, these big banks, they also have a side business where they extend home equity lines of credit, and they would lend people money on second mortgages. Well, if there is a foreclosure, the second mortgagee typically gets wiped out. And so the servicers, in many cases, they had an incentive to delay the foreclosure process as long as possible, because they're going to get wiped out if the foreclosure goes through. So by delaying the process, letting people stay in their homes for several years without making a payment, letting the house deteriorate, that affects the value of everybody else in the neighborhood. And one of the things Beauvais said was that, okay, so the people who, let's go back to the person that didn't pay their mortgage, stayed there for several years, didn't fix anything, let the whole place go to pot, and then at the end of finally when they got foreclosed on, they went out and because they 2 years of not making a house payment or paying any rent, you ought to be able to have enough money to go find a place to live pretty easily, even if you're on unemployment. So they went, those people get out. Those people are going to get a big check, $2,000, around $1,800, $2,000 check from the government. What about the people that have been paying their mortgage? Now, if you're underwater, they're going to help you refinance. And I'm really skeptical of the deal to help people refinance. A lot of the money that's going to be set aside for that is to help people refinance if their home's underwater. Right now, if your home's underwater, of course, your loan-to-value ratio will not allow you to refinance. And because the rates are so much lower now, if you could refinance, you save money. I'm definitely in favor of the idea of people being able to refinance, even if they're underwater, particularly if somebody owes an investor more money than the house is worth. The investor's investment is hanging by a thread. And if they can ensure that it will be paid by refinancing the thing, maybe getting some more equity from the homeowner or something in that process, I definitely think that's a good idea. Just how much of this money is actually going to go to that, I don't know, because the banks are very good at giving you something with the left hand and taking it with the right hand. The fees that they charge for mortgages, I went to pre-qualify for a mortgage to bid on a house that was going through that had been, it was an REO house, and it was actually a credit union that owned it, wanted verification of the ability to pay as we made the offer, and went to the bank, and when I looked at the documentation, they're going to charge me like $800 off the top for like nothing. And then as you read through, there's this loan origination fee, and that was going to be like 1%, like $3,000. And I said, what is this? And the guy, and he was a really good guy. I don't want to say his name because he really is a good guy, and was honest with me and forthright. He says, I'm not actually going to charge you that up front, really. He said, I'm going to hide that. I'm going to put that into like points and other stuff, so you won't actually pay that. Well, if it's being put into points or higher interest rates, being paid somehow. And I said to him, I said, I lent you guys a lot of money at different times in my life. Before I bought, the house we had here, we had money in that bank, quite a bit of money. I said, I never charged you guys a fee to lend you money. I never said, on addition to the interest rate that you're going to pay me on this money I'm going to lend you, you're going to have to pay a loan origination fee. You're going to have to pay this document fee. The thing is, I'm buying title insurance. I buy the title insurance. That protects them. In other words, if there's the title insurance that specifically protects them, it's got to protect the mortgagor. And so it protects them if there's a challenge to the title, or if somehow they lose their, something goes wrong and they lose their rights to it. There's a process by which they ensure that I keep the taxes paid, that I have the home insured. All of that has to be done. So I pay for all the stuff that protects them. And then I'm also paying them an interest rate. Why do I have to pay them another fee? I mean, what's with the $800 fee, the $3,000 mortgage origination fee? I can understand the doc stamps and stuff like that. What are these other fees? I mean, what is that? Why do they have to charge that? Well, I'm just afraid that they're going to say, okay, we're going to, if your house is underwater, we're going to allow you to refinance, and the government is going to kick in $2,000 to everybody that does that, and then they're going to find a way to charge an extra fee that covers whatever they have to kick in. And in many cases, of course, they're refinancing it, and it's not just, there's an investor on the other end of that, and then this deal was just with the company that services the loan. So they're going to find a way to charge an extra fee to cover that. In other words, the government's going to have this money, say, here, we're going to help these poor people that are underwater on this hand, and the bank's thinking, how do we get that money on this hand? What kind of fee can we charge? What kind of new kind of thing can we do? We've got loan origination fees. We got a processing fee. We got a packaging fee, loan packaging fees. So you'll see these new fees, and I'm really skeptical that the banks are actually going to that they're actually going to be forthcoming and do the things that they're supposed to. Some of the money, or actually quite a bit of the money that's in the settlement, goes for deficiency judgment forgiveness. And that's really good in many states. Now, in some states, if you have a mortgage and they foreclose on the mortgage, there's no recourse. They're called no recourse states. There are only a few of those. I know Hawaii, I think, is one. But in many states, what happens is that let's say you owe $300,000. And this is something to pay attention to for anybody that's been through this process. You can go and you can look at this and see it for yourself. You owe $300,000 on your house, and you engage in strategic foreclosure. You know that it's only worth $150,000. So basically, essentially, you mail the keys back to the bank. They want to foreclose. Say, okay, here, foreclose. Mail the keys back to the bank, and then they go through the foreclosure process. And then there's a bidding process. And nowadays, it's almost always done online. And the plaintiff in Florida, the plaintiff always wins. And they use what is called a proxy auction, so that what happens is the plaintiff will usually go in and bid the amount of the judgment. So if the judgment is for $312,000, they'll bid $300,000 as their maximum bid. But it starts at $100. And then if somebody bids $200, there's an automatic bid that's placed that's like $100 more than that. And then if somebody bids $1,000, well, then it's a bid that's automatically placed for the bank up to $312,000. So if you look at if you go to the clerk of the court in any county in Florida, I just looked at some in Gulf County, Florida, for example, where they have an online bidding process for foreclosures, and almost all of the foreclosure bidding processes were won. All of them were won by the plaintiff, and most of them were won for $100. I think there was one that was actually some people bid on, a foreclosure that people actually bid on somewhere. But most of them, almost all of them, were won by the plaintiff, and for $100. So the plaintiff can say, well, we were owed $312,000, and we only got $100. Now, it's actually their own $100 that they got. So they have technically, they can try to enter a deficiency judgment for $311,900 against whoever they foreclosed on. Now, people who get foreclosed on don't have a lot of assets that you can go after. And in many cases, the banks just write that stuff off. But it's still out there. In other words, technically, even if somebody's like in their 20s and they engage in one of these strategic defaults, there's a deficiency judgment out there that is against them and that the bank could pursue. And in many cases, years from now, you'll see this popping up where somebody has gone on, they got a new job, they got a new career, they got a new house, they're doing everything, and all of a sudden they see a $311,000 judgment against the equity they have in their house years from now. So some of this money is going for deficiency judgment or whatever the deficiency was at the foreclosure process, forgiveness. And that's a large amount of money and it's not even real money. Basically, the mortgage have already been written down or written off, so the whatever loss they have has already been written down or written off, so that on the bank's books, they carry that as an asset that's worth nothing. But that doesn't mean that they're not going to try to collect the money. Technically, that doesn't mean they're trying to collect the money. So some of this, for some of this, they're trying to forgive some of that. And unfortunately, and this is the kind of the final thing, and I'll have, when I talk about this, I want to hear what y'all have to say. Send an email in to us. If we somebody particularly interesting, you have something particularly interesting that you email that you send me, we may try to get you on via Skype or something like that to get you on the show. And I'll talk about this again at the end of the week. But one of the things is, I was still waiting to say for just one journalist, all the different interviews, nobody asked them if they could read the deal. I mean, is it going to be posted on the internet? Is it public knowledge? Many states have very strong sunshine laws, meaning that they can't enter into some kind of private deal. Like the banks and the attorneys general cannot have this deal and then keep it secret in most states because of the sunshine laws. But I didn't see any of the states, the attorney generals or anybody else saying, okay, yeah, you can go, we're going to post this on the internet, you can read the details of it. I really need to see the details of this deal before I can give y'all kind of my final opinion on it. And I would like to hear from people, things that I've said that are wrong, things that I've said that are wrong. So we'll do the next one of these, the next podcast. Look for the third podcast, third podcast of 2012 for the next discussion of the mortgage crisis and the return of the housing market and what's going to happen in the future with regard to getting us back on track in terms of housing, what we should have done way back when, what should have been done to try to fix things a little bit quicker, and how do we make sure that this doesn't happen again? How do we make sure, and the steps have really not been taken to make sure that this doesn't happen again. In fact, if anything, it's the opposite. And that's a guilt on both sides. The guilt on the liberal side and the guilt on the conservative side, both of them. The way the Bush administration, guilt for the Bush administration, but there's also guilt for some of the people that, the Community Reinvestment Act and some of the other things. And there's a lot of rhetoric on both sides, and they're kind of both wrong, in my opinion. Bove is wrong, and but then also I think a lot of the stuff you hear on NPR and the stuff I heard yesterday on NPR, some of the stuff you read on Huffington Post and the liberal blogs, they don't have it right either. So send us email, contact us, let us know what you think, what information you have, and I'll be back on as more details come out, although I'm going to be afraid that much of this deal has been kept secret because it benefits this person, the big investors, it benefits the banks. The state's attorney generals get to go and say, Yahoo, I got $200 million from my little state. We don't even have judicial foreclosure, and I brought in $200 million. And the people that are going to be screwed are, number one, the people who out there who live in your house, you're making your payment, you have a job, you're making your payment, even if you don't have a job, you're paying your mortgage, and the people around you are not, and you have homes sitting empty in your neighborhood, or there are these homes that have been for sale for like 2 years that are never going to sell until there's a foreclosure and the price comes down to the natural value. Those are the people who own their homes and are paying on them, and all the other little people are the ones that are probably got screwed in this deal. That's it. Have a nice day.